Okay, I'm going to talk into here, not because you can't hear me, but because they're live streaming it. So welcome. I'm glad you all are here. It's nice to be with you and to have the chance to talk a little bit about investing here in our city. So my name's Monique Lee, and I got into real estate 20 years ago with my husband, Jim. We were in different facets of the industry right out of college. And I was really passionate about consulting with such honesty and expertise that people couldn't help but refer me to their friends and family because their lives were legitimately better for having worked with me. And I felt from the beginning that the team model was the best way to do that. And for 20 years, you guys, this team has been honestly and with expertise consulting our clients such that today, 90% of our business is based on referrals. And that's just a really great place to be. And getting a little bit of perspective, I mean, we all know the market's gone wild, but I think back to 20 years ago, and I think of the guys that were coming and, wanting to quick cash, quick turn, quick this, quick that. They're not the ones that have won over the long term, but it's the guys who, and the women, who bought and held. And you think about the multiple streams of wealth that they were building through the vehicle of real estate. And you think 20 years later, they've got equity, they've got monthly income that's been coming in for 20 years, and they've got all this crazy appreciation. And so for our team, we felt like, we recognize that we have an advantage being in the industry, and we want to share that advantage with our friends and family who for 20 years have been referring their friends and family to us. And so that's why we're here. We're here just as a resource to you all and to say, hey, we're here to help. Let us know your goals. Tell us what you're thinking, and let us be a resource for you. So that's why we're here. You're going to hear about the market. You're going to hear about next steps. You're going to get the chance to meet the team. And we'll be around after for consulting on, more specifically what your goals are. So I think you have a notepad. There are several in the back, but feel free to write down questions that come up that you want to talk with us after, because we're going to be sure to leave time for that, or ahas, or whatever else you'd like to do. So you'll get to meet the team at the end, but I'm going to introduce Andy. Andy's been in business with Jim and I for 10 years, I think, at least, right? I don't know. Feels like forever, in a good way. But we share values, which is why it works so well. And he has really internalized this whole real estate thing and operates in a way that truly puts clients' needs first. And so we're just honored to be in business with Andy, and he's going to come up and lead the seminar tonight.
Thank you, Monique. I'm going to turn this off because I can't do laser pointer in this. A little awkward. So I don't know about you, but if you've ever been to a real estate seminar, they go one of two ways. Like, you either have like this real estate tycoon who's like a multi-billionaire, and he's like strutting around on the stage, and he's like, you only need $500,000 of cash to do what I did. And then you walk out kind of like, okay. Or you walk into a real estate seminar and it's just boring and dry, and you walk out like, okay, we looked at numbers, I still don't, it's like you're in neutral, and you're like, okay, I understand the engine, but how do we like get it into drive and go? And you wind up walking out not any better. And so it's my hope that you walk out of here. It's not just my hope, it's my objective, really. That you walk out of here saying to yourself, that was a fantastic seminar. I came in with a bunch of questions, and I really was able to clarify and not only go out with some tools, but to go out with some resources and some people that I can consult with to actually become active in the market. So, what's up, guys? Check it out. Yeah, just for you. Sorry, it's an inside joke. This is an $8 chain, by the way. some people have negative connotation about real estate investing. I think of like some sweaty guy with a gold change in the Upper East Side, like cruising through the slumlords or through the slums. So anyway, real estate is for anybody and everybody. Anybody can get into it. And hang on one second here. Keep it on? I can't get it off. I'll just sleep with it tonight. Okay, so we want to help you discover why you need to get off the sidelines and into the game. And I want to explain what that means. That doesn't mean, you need to tomorrow get in the market and buy an investment. It does mean that you need to be in the mindset of getting ready to buy an investment, be it tomorrow, 6 months, 90 days, 2 years. And so we are going to talk about the mindset of an investor. This is a debit card that it's like what I use for everything, but I wrote investor on it. It's just a reminder every time I spend money, it's a reminder to me of like, I'm an investor. Because consumers subconsciously, when they earn $1, they say to themselves, I have $1 to spend. When an investor earns $1, he says, I have 50 cents to spend and I have 50 cents to invest. And so I really, we do want to get you in the game because you have to get active. If you're like, I'm going to sit and wait, that never works. So here we go. How are we gonna help you with that? Discover what in the world's going on in the current real estate market. We're going to look at national statistics. It is going to help us. We are going to do the nerd thing for a little while and actually look at where we are in the cycle of real estate right now, because you can make really better and more informed decisions having looked at that. And then we're going to show you what investment opportunities work best in this market, and then teach you how to calculate your ROI on some of those specific examples. So this is the lens of this entire seminar. And to be honest, I am really excited. We're going to have some fun tonight. This was, I've been in real estate quite a while now, and it's so, everybody I talk to is like, the market's crazy. The market's crazy. How's the market? The market's crazy. And the second question is like, well, is it a good time to buy? And I'm going to have you answer that question. That's the beautiful thing of tonight. I'm not going to answer that. You're going to look and you're going to tell me whether or not it's a good time to buy, okay? All right, nerd slide number 1. So this is a 32-year data sample, 1990. Average sales price, $94,000. 2022, average sales price, $378,000. This yellow line is the long-term average of appreciation. Appreciation just means the asset or the home growing in value. And so you have a timeline and you have a percentage. And so over the last 32 years, it's averaged a 4% appreciation. But you can see from 2019 to 2022, that is a jump in appreciation like we've never seen for 32 years. So I'm going to ask the question, because we're going to use that filter. Based on this data, is it a good time to buy? I've got no's. Who raised their hand says no based on this? Don't be afraid. Just make a decision. Who says yes? Okay, Kristen says yes. Yes. Okay. Excellent. Well, I think the consensus is actually no. I want to write that down here on the marker board. Sorry, I lose stuff all the time. Looking for my marker here. Okay, that's great.
Mr. Third option over here.
That's right. That's right. So I think the consensus was no. I think we had 3 yeses and then it depends. Okay? All right, we'll come back to that. Affordability. All right, so this dotted line is an average percentage of how much of a homeowner's income on an annual basis they spent on their mortgage. And the average is 20% of their annual income they spent on their mortgage for 51 years. Okay? Right now, the average amount of money a homeowner spends on their mortgage is 16%, which is well below average. And I think it's interesting that in 1975, it was harder and more expensive to own a home than it is in 2021. You have to remember, this isn't, you have to account for inflation. So people's incomes are going up, expenses are going up, but pound for pound, it's cheaper right now on average to own a home. So is it a good time to buy based on this slide? Okay. Sure. They are.
Not specific to our market.
That's correct. Yes. These are national statistics. Great. Now, great. So this is going to go up. We're going to talk about that in a second. But for now, we're going to say yes. Okay. Inventory. Sorry, I keep hitting this. Is the chain? Yeah. All right. 1999 to 2021. Inventory is just how many homes are on the market to buy. And you can see how it's been dwindling and dwindling and dwindling. And here, 2022, I'm sure it's even lower. So low supply, high demand. Is it a good time to buy? Yes or no? Okay. Why not? Hard to find houses. That's right. You got to fight for it.
Because people are purchasing houses for over asking price, they're waiting inspection, they're waiting appraisal, and they're paying cash.
Yeah. A lot of tough competition out there, for sure. All right, so we're going to say no. Mortgage rates. 1972, 2021. You can see the average over 50 years is about 8%, and the average from 1990 to now is 5.97. Now, Josh, so I'm going to introduce Josh McGinnis real quick. He's in the back, gentleman with the beard, raising his hand. He is a local lender. He works with Benchmark. He's also an investor and is incredibly skilled at structuring investment loans and helping people structure deals and things. But Josh, can you talk to us about interest rates the last 120 days? What has happened?
Rates are hovering around 5.5, give or take a quarter point, depending upon specific situations, and they're anticipated to continue to rise.
Okay.
We're at about a 20-year high on rates. Of course, we do look at this and kind of see that a little bit. And we're also at about a 30-year high as far as the fastest rates have gone up. And so the market's having a real massive knee-jerk reaction. And my line to everybody is, one, it is what it is. You can't change it. You can cry about it, but you can't change it. Number two, with rates being so high, what do you think rates are going to be doing in the not too distant future? And what most people are predicting is rates are going to come down. And so if you can find a good place now and you're good with it, go ahead and lock it down and you can refi it in the future.
All right. Is it a good time to buy based on this? Yes or no, or maybe? Yeah, so who said yes? Did somebody just say straight up yes? Okay. Yeah, so guys, this is crazy cheap money. Like unprecedentedly cheap money. And so we're going from really cheap wholesale discounter money to reasonable below the high cost of money. So yes, does anybody say no, it's not a good time based on this? It's funny because my business partners don't know where I'm going with this, and so I've got a lot of like faces that are, they have no idea where I'm going. This is awesome. So, all right. So what do we learn from this? Well, depending on the lens you use, right? Depending on what lens you use, the answer isn't clear, okay? So here's what we're going to talk about, and I don't want you to cheat, actually. Hang on. Don't look at that. You're not allowed. Or the red numbers. Of course, everyone looks. I know, but don't look at that either. All right, just hang on one second.
It's now on the screen.
Shh. Wait. Just don't look. Oh, shoot, that didn't work. All right, hang on one second. I know I can... Which one is it?
Why don't you duplicate this slide and then just cut that out?
It's too late. Sorry. No, I'm good. All right, just trying. Okay, good. You can't see that. All right. So we're going to look at some specific examples. And I want to be clear, this was not a cut and paste out of a book. These are real numbers that were calculated 2 days ago that are very realistic in our market, okay? So I want to be clear that this isn't, thank you. This is a real life scenario, not just a cutout in a book. So $350,000 price point. We're going to go over just traditional investment loan, okay? 20% down. You got 70K plus 15,000. Closing costs have gone through the ceiling, folks. $15,000 in closing costs. So total cash in, $85,000. And your mortgage winds up being $2,078. That is with taxes and insurance, okay? Now, I'm not ready to give it up, give you the other numbers yet. Okay, this is a different vehicle. This is what we call personal residence purchase, but with the intent to keep it as an investment. Okay, and not everybody can do this, but we're going to go over both numbers. But basically, what you do is you buy through the lens of an investment, and you move every 1 to 2 years. And so you buy, you leave one behind you, you buy, you leave one behind you. And people do that because it's a lot less cash in, and you get lower interest rate. You can see 5.5% versus 6%. All right, let me jump back here. All right. All right, let's look at returns here. So rent rates are going through the ceiling, folks, and we haven't even seen the inflation numbers that are coming on rent in Chattanooga. But it's rent's going through the ceiling. It does not pay to rent right now. So $350,000 home at a $2,000 mortgage, your rent received at $2,600. There are 3 return on investment vehicles here. Number one is just your monthly cash flow. So that's just your mortgage, your rent received, and the difference, okay? And if you multiply that by 12, you divide 85,000, you've got 85,000 in. In 1 year, you're at 7.37% return on investment. Now, this principal, let me just be clear, your principal changes every month. So this is a snapshot, but this principal will actually, you'll pay more and more principal down on your debt. So that just means you're paying your note down and you're gaining equity for yourself, more and more ownership and equity. And you multiply that by 12, divide it by 85,000, you've got a 4.9 return on your cash. Now, let's go back to this slide. Long-term average appreciation, 4%. You can see how that goes up. So I based this number on 4%. And if annual appreciation's 14 grand, that's 16.5% return on investment on 85 grand. So that's a total return on investment of 28%, 29%. Now, let me just ask you, is that a good annual return on investment on $85,000? Okay. Now, it gets better because all of these vehicles wind up compounding. So this is the bottom right here. So someone answer me why this might go up over time. That's right. Inflation, rents are going to go up with everything else. So you're locked into this mortgage, right? But everything's still inflating. So that number is going to go up. That percentage is going to increase. We already talked about every time you pay a mortgage payment, this is going to increase slightly. Now, let's talk about appreciation because this I think is the elephant in the room. Is it a good time to buy on this slide? Right? Well, let's just look at worst case scenario and just stare it right in the face, okay? Let's say you bought at the peak and it took, 1, 2, 3, 4, 5, 6, 7 years to get back to zero. It took 7 years. Well, let's remember that the beautiful thing about real estate in terms of ROI is there are multiple legs to the ROI. And if one leg stagnates for a period of time and you're in the buy and hold game, so Ken Fisher was a columnist for Forbes magazine longer than any other columnist. And I love this quote. He said, "Time in the market beats timing the market." Okay? And Gary Keller said, successful investors, he said, there's an investing myth that successful investors are able to time the market. He said, truth, in successful investing, the timing finds you. His point here was, if you are acting like an investor and actively engaged in the market, the opportunity is there. And if you're in, really this is the takeaway. If you play the long game, you're virtually guaranteed to win and win big. That's just the bottom line. So right now, at the peak of the market, if you're going to buy, you have to be in a buy and hold mindset. Now, this is a bit of a house hack for some of you. This is not going to fit everybody, but if you can look at the numbers on this. This is insane. 28,000 cash in. Now your mortgage is higher because you haven't put as much money down. You have 2362 mortgage, 2,600 rent received, $238 a month cash flow, 10.39% ROI, 450 principal. Remember, that's not a fixed number. That's just a moment in time. That's going to continue to increase. 19.64%. Appreciation on, remember, this is $28,000 down. That's 50% ROI, 81% ROI. So you purchase as a personal residence, you move every 1 to 2 years. And that is a pretty insane cash in return on investment if you use that vehicle. What was I going to say? There's something else. Oh, this also compounds. I forgot to tell you this. So if your house appraises, or excuse me, if your house appreciates in 1 year 4%, now you're at $364,000 value. Well, now the 4% is based on $364,000, not $350,000. So all of these are moving up over time. So any questions or comments on that?
The house on the left.
Yeah.
You bought that was your primary residence for some period of time.
Yes?
You moved and bought another house. You kept that one.
Correct.
You still have a mortgage on it.
Correct.
You can rent it out without the mortgage coming due. Seems like we ran into that several years ago.
Yeah, it's a different loan. You know, between your primary residence and when you take out a loan for your primary residence, the lender wanted it to be our primary residence. And it was going to have to be refinanced to be rental property.
Josh, could you speak to that?
That one, I can absolutely close that with no problem. I don't know when that occurred for you. I don't know the details there, but I'm going to tell you, it's not an issue. If I got more of your details, I can figure it out. But once you close on a loan, this is the beauty of the house hacking thing. Once you close on a home as a primary residence, you're signing a document that says you intend, that's the key word, intend to live there as your primary residence for 12 months. I've done one as short as 3 weeks, but you intend to do it for 12 months. And after that, you can do anything you want in the world with that house as long as you keep paying that mortgage, including getting another house as your primary residence. And the advantage of the primary residence is better rates, better closing costs, lower cash down, all that other kind of stuff.
So somebody, is it a good time to buy? Is it a good time to buy? Okay. Great. That's right. There's short-term vehicles. We're going to talk about some vehicles now. So your short-term plays. So if you want to cash out, now is the time to sell. I mean, the slides kind of showed that. So if you're at a peak and you want to pull a bunch of equity out, based on the appreciation we saw between 2019 and 2022, it's obvious that now's the time with demand as high as it is and inventory is low. So these are short-term plays. Build to sell. Okay? I did want to mention this because a lot of people, their first thought is, well, I'm not a builder. That's their first thought, I'm not a builder. Well, we have a client right now who is building 2 houses in Hickson. He selected a builder. The builder helped him with the floor plans. He's building them to sell, and he's going to make a short-term play. It's going to work, and it's going to work out well. So short-term play, build to sell your primary home, sell your investments. We're not really going to talk about that. Long-term rental, long-term play. We just went over 2 long-term rental scenarios, and the numbers speak for themselves, really. Airbnb. If you want to increase your ROI on cash flow, you can do Airbnb. Now, I will say there's a temporary moratorium if you're wanting to do it by the book and get a business license. There's an envelope in Chattanooga that you can look on the GIS, and we could get that for you if this is something you really want to talk about. But they're kind of redoing the legislation because of big box investors coming in, building apartment complexes, and then getting them Airbnb'd, and they're trying to like put the brakes on that. And so for a season, if you're trying to apply for a new Airbnb, you're going to stall out for a while. But it will come back. It will come back in the game, probably in the next year and a half. And there also is there is a proposal for exterior dwelling units that they're going to approve, like building a secondary unit in an R1 situation, which is actually going to be a huge benefit to homeowners. Then you have multifamily. Build and rent, that's another one. So you could hire a builder, build it, and turn around and rent it. We know that new construction gets the highest rental rates, and it's no maintenance for 10 years. So it's kind of, if you're looking for a plug and play, build and rent could be one. I forgot to put flip on short-term play. Flips are more complex. You really have to be in the market and understand the numbers. It's not really a novice. It's not a novice. I want to say novices. Is that a word? Novices, like possessive? It's not a novice play. Thank you. Yeah, not a novice play. But flips are still, they're still out there. You really have to be careful with the numbers because of inflated prices, but you can find them. And then buy land. That's a long-term play. Buy a parcel of land, sit on it, subdivide it, maybe build one house, keep the rest of it for later. That's also a play. So. Questions and comments. Jim, do you want to add to any of this? Because we're kind of.
Sure.
Okay, great.
Is this like question and answer time, or you want me
No, come on up here. Yeah.
for those of you that are
Here. Sorry. This thing on.
Where's my gold chain?
I can take this off and get
So, no, I'm good. For those of you that are interested in short-term vacation rentals, there is a moratorium in the city. The moratorium does not apply outside the city. And so if you have an STVR that's licensed, keep it, don't sell it, because that is good. The supply right now of STVRs in the city is dwindling because there will be no new approved applications while that moratorium is in place. Now, the city council has no intention of taking as long as moratorium is to actually get new legislation to manage STVRs. The reason they're doing it is that they, like he said, they had people essentially trying to circumvent hotel zoning. So, you have to have R3 zoning to be able to do hotels. And people were circumventing that by, going the R1 route or different routes, and they were building large buildings, and then they didn't have R3 zoning, but they were just applying for 50 STVR licenses, at a snap, and there was nobody to dispute that because, they send out letters, but it was in a new build area, so there were no residents to dispute it, so they had no mechanism by which to deny those. So they were literally having to approve 50, 100 at a time, and I was like, this is insane. We're basically approving the building of hotels, and that's not the intent. So they said, whoa, time to slow everything down, and we're just going to put a moratorium and stop. And while we're doing that, our big goal is to go ahead and reinvent accessory dwelling units and how those are handled. So accessory dwelling units is basically anything that is added on to your house that you are allowed to rent. And you may or may not know, but that's called a duplex right now. And unless you have duplex zoning, it's an illegal use of your house. So you can't just go, add a unit over your garage and rent it. If you do, you could get shut down, as people have learned. You can't just go take a basement and then, add a kitchen and a bathroom and then start renting it to somebody. You can, but you can get shut down. If anybody complains about it, you can get slapped with fines, cease and desist, and that happens all the time. And it's a non-conforming build. It's a non-conforming use. So then when you go to try to sell it, you're selling a non-conforming parcel that never was permitted properly and can't really be used to sell as a true investment. Well, now they're changing all that, and they're saying, we love accessory dwelling units. We love them. We're going to approve them. We're going to create legislation around how they can be built and created, so you're going to have the ability to build on to your existing structures or to your garages and into your basements accessory dwelling units, and they're going to love that because they're looking at that as like an owner-occupant who is essentially adding on to their house in some form or fashion, and then turning that into a cash flowing investment. It's going to be legal. It's going to be a rubber stamp process to get that approved for STVRs, and it's not going to be a problem. So that's going to be a huge way, just as an owner occupant, to say, hey, I have this existing mortgage. I can spend some money here, and the ROI on that's going to be insane. So they are planning on coming back to the city with a proposal that both combines new STVR legislation and ADUs. And there's going to be some type of upper limit or cap on STVRs. They're going to very, very much try to put legislation in place to discourage completely out-of-town investors from coming in and just slapping down massive, STVR licenses all at once. There's going to be a lot in place to prevent that from happening. There's going to be a lot in place to make it much easier and legal and possible for owners to build ADUs and to turn those into STVRs. And there's going to be some kind of an upper limit cap placed on how many STVRs will be approved in any neighborhood at any given point in time. Because what they don't want, if you've ever been to Orlando and you've, gotten an Airbnb or an STVR out there, the entire neighborhood is STVRs. Like, there are no owner occupants in there. There might be one or two, and they're surrounded by STVRs. So they want to prevent that from happening in Chattanooga. They don't want your neighborhood to be taken out so it's like 90% STVRs and you're one of the 10% homeowners stuck there. They're going to want to see that ratio inverted. So anyway, all that to say, the opportunity isn't going away. But there's a moratorium on it. So if you have them, enjoy them while they last. They're going to have new rules if you've been, not while they last, but enjoy them while this moratorium lasts, because nothing new will be coming onto the market. So if you have them, you should be able to be raising rates actually, and just taking advantage of a market with no new supply coming in right now. And then anytime there's a sale, that license goes away right now. So if you own the property in your name and you try to sell it to somebody else, boom, that license goes away. That new owner can't apply for it. So again, you're going to have no new supply and dwindling, and nothing new coming in, and dwindling supply as people exit it. So take advantage, raise your rates right now as long as that moratorium lasts. And then also, I say, start drawing up plans to take your existing, residences and units to be ready to go ahead and add ADU units to those, because for the first time, that's going to be an opportunity which has a massive return on investment, because you already own the land, you already own the house, you already own everything. Now you're just adding a structure inside an existing basement or attic or garage, or even building a new garage, which you can do for cents on the dollar compared to acquiring new land, building a new house, so on and so forth. So those are some thoughts there. Any questions on that? Yes. It's new to the market. You're dealing with probably some more conservative banks. They're not all like that. Like I've had the opposite problem where banks want to lend me way too much money based on STVR income. I'm like, well, hold on, hold your horses. Like I actually want to just, lend on this based on conservative, rent and not on STVR. Josh, you had a comment on that.
The issue at play is short-term rental is considered variable income, and so the industry standard is a 2-year history for variable income to establish credibility for it, and so that's what you're probably running up against. There are a few ways around that, but that's the issue at play. As soon as you have a 2-year history, it is as rock solid as it gets.
Yeah, and you're probably talking more conforming, market as well as opposed to private. Yeah. 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 Okay, great. So one thing that's a great, Monique's reminding me that's a great individual question. So there's portfolio financing, which is what we do, and then it sounds like he has some answers as well for conforming loans. So let's look at that. I wanted to go back to the land thing as well. So as far as the buy land and hold, I think that's an excellent investment strategy. And when you're buying land to hold, it is really, really helpful if you can buy, what I love to look for is, land that's several acres and it's got like a house on it that I can rent. And so I'm land banking that, but I'm making income on that land while I keep that rental. I intend to tear down that rental someday and develop and subdivide into a neighborhood. But for the meantime, I'm making, money on my investment. It's appreciating in value. And so that's a great way to buy land these days. What he said, the build and sell does work really well for short-term cash. But I will tell you this, some of my worst regrets are the places I've sold and the places I didn't buy. Does that make sense? So like I can drive around Chattanooga and be like, should have bought it, should have bought it, should have bought it, should have bought it, didn't. Shouldn't have sold it, shouldn't have sold it, shouldn't have sold it, right? And I'm just like, dang it, man. Like, I thought the market wouldn't go any higher, so I sold it, and boy, was I wrong. So I do want to, affirm that buying and holding is, I think, what has made me the most amount of money in real estate. It made me the most success. So, yes. Yeah, rent rates are really high right now. In fact, on some level, some of that is conservative. Like I've seen rent rates much higher than that. Much higher than that. So affordability for rentals right now is an issue, but yes, it is pretty easy to get some very high rent rates right now. So I'm good. I just wanted to add that piece right there. Do you guys, yeah, go ahead. Yeah.
Okay, so I'm going to talk about another form of investment. A lot of first-time investors just don't have the cash on hand. And so the way that we get around that and still continue to do investment properties is something called house hacking. And I want to tell you guys basically about some of my clients. So they bought a house, lived in it for a year. It was their primary living residence. There we go. And they decided they wanted to invest. So instead of selling this house, they saved the money for a down payment, bought another primary residence, moved their entire family there, stayed there for a year, did it again. So now they have 3 investment properties, and they're currently using the money from those to build their dream house. Once they do that, they'll be able to refinance and buy another investment property. So that's kind of what we're looking at right now, and it's, in my opinion, my favorite way to invest. That's really all I got. Sorry. There you go.
We want to leave a lot of time just for like individual consulting, because when it comes down to it, it's kind of like, okay, what's your situation? What are your goals? What is it that's most important? But I think the thing that's loud and clear is buy and hold and you're good. The guy that I look back that 20 years ago bought and held, he's sitting really pretty right now. Think if you bought the house across the street from you 20 years ago and had been renting it out for 20 years. So that's the beauty of real estate, as well as obviously the 3 streams of income that he went over real clearly at the bottom of that graph. So I'm going to briefly introduce you to the team so that you know who you're talking to. If you have questions or if you're messaging in, you can message a certain person or whoever you would like. So Jim and I, Jim Lee and Monique Lee, Jim is the brains behind all of our brawn. I'll just put it that way. He does all kinds of things in real estate, has done some developing or does developing and continues to pour into our team and help us as we assist clients. Andy Bond, he works with all of our home sellers. So when you are thinking about selling, he will come out and consult with you and talk about strategies to really maximize your home sale and the price that you're getting, as well as the ways that we minimize stress. So, and then our home buying consultants, stand up, are KK and Kristen, and Ethan couldn't be here, Mark as well as part-time. And they work there. What I love about the team model is that everybody can work at a high level. And so they will meet with our home buyers and really look at their priorities and service the entire time accordingly. They're awesome at what they do. I'm so thankful to be in business with these people. And then Jordan, she runs the office. She tries really hard to keep us all straight and rarely is able to achieve it with the 9 of us. But Jordan runs things, as you can see. She knows where the markers are and everything else. She markets all of our properties, is always on the cutting edge of strategy, and is just amazing. And then Ashani in the back works with every single client that comes through. She takes the client from the time that they're under contract all the way through to closing and takes care of every single detail, so that the time that is often the most stressful in a real estate transaction for most of our clients is really not that bad compared to what it would be without her. And so we're very thankful for every single person, but I am just honored to be in business with them. So KK is going to tell you your next steps.
Okay. Yeah, this is just going to be kind of refreshing again of what everybody else has already said. But if you wanted to do a consult with us, we're going to have some time that we're going to stick around after. If you wanted to grab any of us agents to talk, or if you don't have time right now, you could message us or come grab us and set up a time to talk later. But what a consult with us would kind of look like is just going back through us sitting down, asking you a ton of questions and establishing a strategy with you. So what's the lifestyle you have? What season of life are you in? What are your financial goals? Like, really, what are you trying to achieve? And we want to ask as much as we can at the beginning so we can really help you reach those goals successfully. So for like my husband and I, it's like at our age, like our resources are more limited, but we have a lot of freedom with our life and our time. And so for us, it's the whole like buy a home and then every 1 to 2 years, like go get a new primary residence. So that is the strategy that works best for us, is what we're seeing. So sort of, again, just figuring out what would be best for you. And then second would be picking your investment vehicle. So like Andy went through, talking about, like, are you hoping to do long-term rental? Are you hoping to do STVR? Do you want to go buy land? Like, really, what is the vehicle you're going to be using as your investment to be able to make that money? And then thirdly, finding your product and negotiating. So then that's where we're going to come in and help you and start talking about different neighborhoods and areas of town and the type of residence that you need to be buying, making sure you're hooked up with a local lender who knows what they're doing and can really help run those numbers to make sure you're making a profit off of it, and again, reaching the goals you have financially especially. So we would love to be able to talk with you or sit with you and, yeah, just help with any questions. So I know we have time right now if you have questions about a consult or just about anything we've talked about or real estate related. And we really thank you for coming out and appreciate it. So. Oh, and Jim's going to wrap up.
Yeah, I'm actually going to, so I am going to wrap it up. That's good. I just, in closing, I do want to share like a couple thoughts because of the perspective that I do have, because I actually lived through the market crash, of 2006. I mean, I, know some of you guys from then or before then. And there were some, I love this slide that Andy had. I'm going to go back to it. So this is when, look at what happened to the prices, and look at how far in excess it started to go above that 4% appreciation. So this is your, this is kind of when it started to all crash back then. Look what was going on with the affordability. So look how much affordability was driving up above. And we were getting warning signs at the time from Gary Keller saying, watch out, affordability, watch out, affordability, watch out. And then there was, and sure enough, look how much above affordability it was, and look how far below it we still are right now. So we're not getting those same warning signals on affordability. We're getting the opposite. Like things are still, in comparison to what people are making, still very affordable. And then the other thing is that the supply started to tick up. So look at what was going on with supply in 2006, which was actually the highest, the best year for appreciation and values in Chattanooga. It was 2006. There was already the warning sign of affordability that people were like, watch out, watch out. And there was already the warning sign of supply. It had begun to exceed the 6 months. It had jumped up 2 months. Guys, supply right now is ridiculous in Chattanooga. You would have to increase the number of homes on the market by a factor of 10 in order to get to a 6-month supply. So instead of the 350 some odd homes that are on the market in this giving snapshot of the market, you would have to increase it by 10 to 3,500 to balance out the demand to arrive at 6. So that's not going to happen. Like, we're not just going to come up with 3,500, homes. The supply isn't there to be able to do that. So we are so far out of whack from the demand. And one of the things that I think I haven't heard enough people express is that the demand here disappeared overnight because it was being driven by subprime lending and by really, really loose lending standards. And we were getting warning signals from Gary Keller about the same thing back in the day. Like, lending standards are really, really loose. There are people buying homes that should not be buying homes right now. There are, and they're probably not going to hold on to those a long time, and that could create some problems down the road. And sure enough, the problems were worse, actually, than a lot of people even imagined. Now, we don't have that issue. Lending standards are still very strict. Lenders have learned from the mistakes of the past to keep their standards pretty strict, which is why when somebody shares problems, like they're having, I'm like, that's not such a bad thing, you know what I mean? I'm glad the lenders aren't just jumping onto this STVR market and that they're being a little bit slow to do it, because it was their lack of slowness in the past that caused this crash. We have none of those, all the fundamentals are completely different right now. And if you think about it, up until recently, the demand for Chattanooga housing has been driven by the Chattanooga job market. And so basically, if the job market was good, people would move here and they would buy houses. Right now, it's a completely different story. Most of the people buying all the homes that we're building and we're selling and whatnot, so many of them are out-of-town folks. It's like, oh, you got a job here in Chattanooga? No, I just work remotely. My company said I could live wherever. And then we've got people that normally would have been selling their houses, putting their homes on the market, moving to Washington to work with DocuSign, and finding out, hey, you don't have to do that. We'll still pay you your $300,000 salary a year, and guess what? You get to go ahead and stay in Chattanooga. You were making $75,000 in Chattanooga. Now you're making $300,000. You don't have to move to DocuSign. You get to stay right here, and oh, by the way, that's now $1 million buyer in the market, So those kinds of, that's a real story. That's a real story. So those kinds of stories are happening all the time. And those people are getting to stay here, not leaving, and new people are moving to Chattanooga because they're saying, whoa, I can live anywhere. Gosh, Chattanooga still looks really affordable, nice sunshine, nice outdoor living, nice community. There's so much drawing people to live in Chattanooga. So now our demand is not isolated to just the Chattanooga job market. It's really anybody in the nation who wakes up and says, you know what? I'm not loving the political climate in my state. Where could I move and go somewhere I like? And so they move, to Chattanooga for different reasons. Or, hey, I need some more sunshine. Where could I go? Chattanooga, hey, I need a family-friendly environment. Where could I go? Chattanooga, hey, I love the outdoors. Where could I go? Chattanooga. So that's why we're getting so many people moving here. And so this demand is not predicated on just what we're drawing from here. So I think those are some of the reasons that we feel, and I feel personally, it's a good time to buy and to hold. And I'm not telling you guys anything that I'm not preaching. Like, I am not selling anything. I see friends of mine that are selling, like, why are you selling your investments? Like, hold on to your investments. Buy more investments, you know, and I'm sorry, Mr. Seller. Sometimes you do need to list and sell, but why? You know, where are you going to put that money that's going to do better than the Chattanooga real estate market? You know, I just don't see that many places that there's the security and the stability of the Chattanooga real estate market. So I'm continuing to stay in it pretty heavily. So without further ado, just thank you so much for coming in. Thank you, Andy. Thank you, KK. Thank you, all you guys, for everything you did to put this together. And we're going to hang around and answer any one-on-one questions you might have. So thank you very much.